The national housing market is fine. It's stable. It's balanced. And that is the most dangerous narrative in real estate today. While the official story is one of a soft landing, a silent correction is already underway in some of America's most critical markets. This isn't a forecast. It is a present-day reality. A reality being obscured by misleading national averages. In this analysis, we will examine the hard data from two bellwether states, Florida and Texas, that shows the 2026 correction is already here. First, we will uncover the insurance shockwave causing a silent freefall in Florida. Then, we will dissect the oversupply bust creating a race to the bottom in Texas. And by the end of this investigation, you will have a precise framework to analyze your own zip code and determine if your local market is next. On the surface, the story being sold is a comforting one. Headlines from major financial news outlets are all painting a picture of a resilient market for 2026. They point to national data, suggesting prices are projected to see modest growth, perhaps 1% to 2%. They'll show you that home sales are expected to rise for the first time in years, by as much as 14%. And the centerpiece of their argument? Mortgage rates. After years of sustained pressure, they are forecast to dip back into the low sixes. Redfin has called it the Great Housing Reset. JP Morgan states prices are merely stalling, not crashing. Realtor.com is calling this the most balanced market since the pandemic. It all sounds perfectly reasonable, a collective sigh of relief. But this national average is a statistical illusion. It's an average so broad that it masks the distress signals coming from specific zip codes. By blending stable, predictable markets in the Midwest with the developing downturn in the Sun Belt, a false picture of calm is created. This calm is a mirage. The moment you stop looking at the country as a whole and start looking at the specific markets that define the pandemic boom, the entire story changes. The national numbers are hiding a brutal truth. In the very places that saw the most explosive growth, a painful correction is already in motion. So let's pull back the curtain, starting at ground zero, Florida. For years, it was the poster child of the real estate boom, a symbol of explosive growth. But the foundation of that market has cracked, and the cause is not what you think. It isn't interest rates or traditional market cycles. The real story in Florida is the hidden bill that arrives after the mortgage is paid, homeowners insurance, and it has become an absolute nightmare. Due to the rising frequency of severe weather events, insurance costs have skyrocketed. Homeowners are reporting premium hikes of 30, even 40% year over year. For a growing number of people, the annual cost of insuring their home is getting dangerously close to their annual mortgage payments. Think about that for a moment. What happens when the cost to insure your home rivals the cost to finance it? This isn't a theoretical problem. It is a forced selling trigger. People who could comfortably afford their mortgage are now being compelled to sell because they simply cannot absorb an extra $1,000 a month just for insurance. This dynamic is pushing a wave of inventory onto the market that has nothing to do with the quote-unquote lock-in effect. These are not people who want to sell. They are people who have to sell. And the data shows the damage. Look at Cape Coral. Projections show it's facing one of the single largest price declines in the entire country. Home values there are expected to fall by over 10% in 2026 alone. In pockets like Punta Gorda, condo prices have already fallen dramatically. The pain is spreading. The Northport, Sarasota area, another pandemic hotspot, is also projected to see price declines. Tampa, once the darling of the Great Migration, now faces a projected drop, with some data showing a potential 3-year decline totaling 15%. What you're witnessing is a regional housing depression. While the national conversation revolves around mortgage rates, the conversation on the ground in Florida is about financial survival. Buyers are calculating the all-in cost, mortgage, taxes, and a crippling insurance bill, and they are walking away. But this insurance crisis is only one way a market can break. Let's head west to Texas, where a completely different and perhaps more classic story is unfolding. Florida is not an isolated case. A different version of this correction is playing out across Texas. The story here is not about insurance. It is a textbook case of a boom and bust cycle driven by one factor: supply. During the pandemic, when demand felt infinite, builders in Texas went into overdrive. The mantra was, if you build it, they will come. The problem is they kept building, even after the frantic music of 2021 stopped playing. Now, the great remote work migration that fueled the Texas boom has crested. The flood of buyers has slowed to a trickle. This has created a toxic combination, a massive glut of new build inventory hitting the market just as demand is reverting to the mean. This is where the model breaks for individual sellers. Homeowners who bought just a year or two ago now find themselves in direct competition with massive, well-funded builders who are desperate to offload standing inventory. These builders are offering huge incentives, mortgage rate buydowns, and deep price cuts to get homes off their books. It's a race to the bottom, and the individual homeowner simply cannot compete. The numbers are staggering. Look at Dallas, which is experiencing a significant market correction with mid to high single-digit declines depending on the suburb. Then there is Austin, the epicenter of the pandemic housing mania. After years of 30% annual gains, the party is brutally over. Analysts are now using the term full-scale crash, with data confirming that home values have fallen nearly 24% from their peak. The story is similar across the state, though not uniform. San Antonio is seeing a much more balanced and stable market, proving again that all real estate is local. But in the suburbs near other major hubs, the declines are very real. While the national media talks about a housing shortage, some subdivisions in Texas are drowning in a sea of available homes. So far, we've uncovered how the official story hides the reality in Florida and Texas. We have an insurance crisis and an inventory glut. These are the first two pieces of the puzzle. If you believe that local data is the only way to see what's really happening, you're in the right place. I track the leading indicators that show up months before the headlines do. To continue this investigation with me, hit that subscribe button so you don't miss what comes next. So we have an insurance fire in Florida and an inventory flood in Texas. Why should a homeowner in Ohio or a buyer in California care? Because these are not isolated problems. They are symptoms of two fundamental shifts that are beginning to ripple across the country. First, we are seeing the true definition of an affordability crisis. For 2 years, the focus has been on purchase price and mortgage rates. But the total cost of home ownership is what truly matters. In Florida, the breaking point is insurance. In other areas, it could be soaring property taxes or HOA fees. The financial resilience of homeowners is being tested like never before. And these carrying costs can force you to sell no matter how low your mortgage rate is. Second, we are witnessing the great unwind of the pandemic housing frenzy. That FOMO-driven migration of 2021 was an anomaly, a historical outlier. Now the market is reverting to its fundamentals. And like a rubber band stretched too far, the markets that were stretched the most, like Austin and Tampa, are the ones snapping back the hardest. Now, the economists pushing the soft landing narrative will push back. They'll say, hold on, there's still a nationwide housing shortage. But a national shortage is a meaningless statistic to a seller in an Austin suburb who is competing against 25 brand new, discounted builder homes down the street. Local reality trumps national theory every time. They will also point to cities where median home prices are still positive. But that just proves the point. It creates a haves and have-nots market, where some regions appreciate while others are in a brutal correction. This deep divide is exactly what hides the crash within the national average. They are telling you not to worry about the fire in the kitchen because the bedroom is still a comfortable temperature. This is the part most homeowners don't see coming. This brings us to the most important question. How does a regional downturn become a national problem? What starts in Florida and Texas doesn't necessarily stay there. A regional correction can spread, and it happens in 3 distinct ways. First is the psychological impact. As stories of homeowners and investors getting wiped out in Tampa and Dallas become more common, the national investor sentiment that drove the boom begins to sour. Capital is cautious. Money pulls back, not just from Florida and Texas, but from any market now perceived as overheated or risky. Second is the risk of financial contagion. Large investment firms who are over-leveraged in these declining markets could face serious liquidity problems. To cover their losses, they may be forced to liquidate assets in their other, more stable markets. A A fund taking a major loss in Cape Coral might have to sell its portfolio in Atlanta or Phoenix to raise cash, putting unexpected downward pressure on prices there. Third, the forced selling phenomenon could spread. The insurance crisis is hitting Florida hardest right now, but other states vulnerable to natural disasters, like California with wildfires or Louisiana with floods, are facing similar premium pressures. The number of homeowners forced to sell due to unbearable carrying costs could grow, adding unwanted supply across the country and overwhelming that so-called shortage. You don't need to believe in the 18-year real estate cycle to see the logic. The pressure is building. What begins as a handful of regional downturns could eventually become heavy enough to drag the entire national average down, revealing the crash that was already happening just beneath the surface. Let's be clear, the single most misleading number in real estate in 2026 is the national average. It's a tool being used to obscure the truth, not clarify it. The market isn't having a soft landing, it is fracturing. It has become a tale of two Americas, one where prices are stable and another where they are in a dangerous double-digit correction. The real story isn't in the national headlines, it's in your local data. To protect yourself, you need to become an expert on your own backyard. You don't need an economist for this. You need a checklist and your local data. Here's the framework. This is your personal market audit. Check these 7 data points for your own zip code. Price cut percentage. What share of current listings have had a price drop? Inventory levels. How many months of supply are on the market? Is that number rising sharply? Insurance quotes. Get a current quote for a property in your area. How does it compare to 12 months ago? Total carrying costs. Track your local property tax and HOA fee trends. Are they sustainable? Builder incentives. Are local builders offering significant discounts or mortgage rate buydowns? Days on market. How long are comparable homes sitting before they sell? Is that trend line growing? Net migration data. Is your area still gaining population, or has that trend started to reverse? The trends in your city and your zip code are the only truths that matter. Do not allow yourself to be lulled into a false sense of security by a comforting but misleading national narrative. The real estate crash of 2026 is not one giant wave. It is a series of devastating local floods that are already here, for anyone with the clarity to look past the official story. To keep tracking these local trends with me, make sure you are subscribed, because in this market, what you don't know can and will hurt you.